Welcome to today's lecture. Today we're going to focus on accrual-based accounting and also how to record adjusting journal entries. Now, adjusting journal entries are quite a challenging topic, and what we're going to do today is break this out into two parts. In part one, we're going to focus on deferral adjustments, and then the next video, part two, is going to focus on accrual adjustments. So let's talk a little bit about adjusting journal entries first and why they need to be made. But before we do that, we have to talk about what is a transaction from the perspective of accounting. So what are transactions? Well, transactions are basically business activities that have a financial impact on a company's assets, liabilities, or equity. So from an accounting perspective, in order for it to be considered a transaction, there has to be a financial impact on either the company's assets, liabilities, or equity. We only record transactions when there is this financial impact. If there is no financial impact, even though there might be some sort of business activity, those are not recorded in the accounting records of the company. One thing to always keep in mind is that the exchange of cash is not always required for there to be considered a transaction from an accounting perspective. So some transactions don't involve cash. The exchange of cash is not always required. It's important to keep that in mind. Let's talk a little bit about whether or not the following examples are transactions or not. Let's look at the first example. Let's say a company prepays rent for the next month. So they give their landlord a check, but the check is for rent for the upcoming month. And so they haven't actually incurred any rent expense yet because time has not passed. Is this considered a transaction that needs to be recorded? Yes, it would be, because cash is leaving the company's hands, so that's going to affect their assets. So there is a financial impact, and so yes, even though rent expense has not yet been incurred, there is a financial impact to the company's assets, and so therefore they would have to record this transaction. Cash is being reduced, and conversely the company would have to set up a new asset called prepaid rent expense. Let's look at the next example. Let's say the company makes a verbal offer to purchase some goods in the upcoming year. They call up the company where they purchase their inventory from, and they say, we're planning to purchase 1,000 units in the next year. Would that verbal offer constitute a transaction? Is there a financial impact on the company's assets, liabilities, or equity? No, there is no such impact. So this verbal promise is not a transaction from an accounting perspective, so there would be no journal entry recorded. Let's look at our last example. Let's say we've used up $100 in electricity, but we're not going to pay that until next month. Would there be a transaction that we need to record? In this case, yes. We've incurred an expense. We've used up some electricity, and even though we're not going to pay it until next month, because we've used up some electricity, we have to make that journal entry recording this month. Let's talk about adjusting journal entries then. Adjusting journal entries are made at the end of the accounting period. So they're done before a company prepares their financial statements. And a company can prepare their financial statements at the end of the month, at the end of the quarter, or at the end of the year. So when they get to this point in time, before they prepare their financial statements, whether it be at the end of the month, end of the quarter, end of the year, the company has to determine whether or not it has to record any adjusting journal entries. Now, the purpose of adjusting journal entries is to make sure that the company captures all the expenses and revenues for that period so that they're properly recorded in their financial statements. And adjusting journal entries never involve cash. When we get to the end of the accounting period, we want to just make sure we adjust all the accounts so that we properly record all the expenses and revenues, but adjusting journal entries never involve cash. That's really important to keep in mind. Now there's two types of adjusting journal entries, deferrals and accruals. And in this first part, we're going to focus on deferrals. So what are deferral adjustments? Well, a deferral adjustment results when cash was exchanged earlier on in the accounting period or year. So there was an exchange of cash earlier on, but the substance of the transaction hadn't occurred yet. What's an example of that? So let's say on June the 1st, a company prepays their business insurance for the next year. They make that payment on June the 1st, but because that coverage is for 1 year in advance, they actually haven't used up any of that insurance. So the substance hasn't yet occurred. Even though they've exchanged the cash, they still have to record a journal entry, but they can't record any insurance expense until some of that insurance has been used up. Another example is, let's say we receive a deposit from a customer for some services that we're going to provide our customer next month. Even though we've received the cash and we have to record the receipt of cash, we cannot record any revenue until we've actually performed some services to earn the revenue. So the substance hasn't yet occurred. So what happens at the end of the accounting period? Well, at the end of the accounting period, we have to figure out how much of that substance has taken place, and then we have to record the expense we've used up or the revenue that we've earned. So if you've used up some of that insurance expense, we have to figure out how much did we use up, make that adjustment at the end of the accounting period. If we're talking about that customer deposit that we received, we have to figure out how much did we earn at the end of the accounting period and record how much of that revenue we've actually earned up until the end of the accounting period. Let's take a look at some specific examples starting on the next slide with respect to expenses. Let's say on November the 1st, we pay our landlord $12,000 for 6 months of rent in advance. So we give them a check on November the 1st for $12,000, and that represents rent for the next 6 months. Now, because time hasn't passed yet, we cannot record any rent expense. But because we've given them a check for $12,000, we've given them some cash, we still have to make a journal entry. So what's going to be that journal entry on November the 1st? We've given them cash of $12,000, but we haven't used up any of the rent, so we can't record any rent expense. So the journal entry needs to be a debit to an asset account called prepaid rent or prepaid rent expense for $12,000 and a credit to cash for $12,000. Now we set up this asset account because this is going to be a benefit to us for the next 6 months. We've prepaid our rent for the next 6 months, so we have this new asset called prepaid rent or prepaid rent expense. So we're going to debit that, and because we've given them cash, we're going to have to credit our cash account for $12,000. So what happens when we get to the end of the accounting period? Let's say that that's December 31st. We have to figure out how much rent we've used up. So let's think about this. We paid them rent for 6 months in advance on November the 1st. When we get to December 31st, then we would have used up 2 months of rent. So we know we've used up 2 months of rent, and now we can record 2 months of rent expense. But how much in terms of dollars would that be? Well, we gave our landlord $12,000 for 6 months of rent. So therefore, it's $2,000 of rent expense per month. And if we've used up 2 months, then we would have used up $4,000. So how do we make this adjusting journal entry at the end of December? Well, we can now record rent expense for $4,000, representing the rent expense for November and December. And then we're going to reduce our prepaid rent account, which has a debit balance, by $4,000 as well. So the prepaid rent account goes from $12,000 minus $4,000, and we have a balance remaining of $8,000 at the end of the year. Let's move on to deferral adjustments with respect to revenue. So let's say on November the 15th, we receive a $30,000 deposit from our customer. And let's say we're a cleaning service business. And so our customer pays us $30,000 deposit, and that represents 3 months of cleaning services that we're still going to give our customer starting on November the 15th. So we haven't earned any of the revenue yet because we haven't started providing that cleaning service, but they've given us a deposit for $30,000. So how do we record that? Well, we received cash, so we're going to debit cash for $30,000. And because we owe our customer 3 months of cleaning services, we're going to set up a liability account called unearned revenue. Debit cash $30,000, credit unearned revenue $30,000. When we get to the end of our accounting period, December 31st, now we have to figure out how much revenue have we earned. Well, on November the 15th, we received a $30,000 deposit for 3 months of cleaning services in advance. If we earn that $30,000 evenly over 3 months, at December 31st, we would have earned 1.5 months of that $30,000 deposit. So 1.5 out of 3 months is basically 50%. So we would have earned 50% of that $30,000 deposit, which is $15,000. So what's going to be our adjusting journal entry at the end of the year? Well, we're going to reduce our liability by $15,000 because we provided those services now to our customer, so our liability goes down. And we can now record service revenue of $15,000. We've earned it, so now we can record the service revenue for $15,000. So that's the adjusting journal entry we would make at the end of the year. So let's just quickly summarize deferral adjustments. Deferral adjustments with respect to expenses. So this is where we've prepaid the expense in advance. When we get to the end of the year, we have to make an adjusting journal entry. And that adjusting journal entry is going to involve an asset account and also an expense account. With respect to deferral adjustments with respect to revenues, that means that we received some cash or deposit from a customer earlier on in the year. Now when we get to the end of the year, we have to make an adjusting journal entry, and that adjusting journal entry is going to involve a liability account and also a revenue account. So that's the end of part 1 with respect to deferral adjustments. Take a break and then start part 2, which we're going to focus on accrual adjustments.